My name's David Dix. Joining me today is Tony Edwards, Chief Investment Officer of the business. Tony, it's been a particularly strong period for investment markets over the past 6 months. Can you just talk us through what's been driving investment portfolio returns and also the bounce that clients would have seen in their own portfolios over this period?
Yeah, sure, David, thanks. Look, it's been a strong year for 2019 so far. Global equities or shares are up about 20%. Australia and the US are at all-time highs. Europe's a little bit behind their all-time high from last year, but they've still had a very, very strong return. What's really interesting is it's been valuations that have driven the sharp returns or the very high returns into 2019. It's not being driven by earnings. And where that sees us is despite we've had this very, very strong growth in markets, the US is about 2% above its prior all-time high, and Australia's done a bit better. It's about 9% above its all-time high. And to put that into context, we've actually got to go back to 2018, where we actually had some quite negative returns in the latter part of that year. So we've seen a bit of a V-shaped recovery. In the final quarter of last year, US equities fell about 14% and Australian equities fell about 8%. And that was really driven by deteriorating economic data in the back half of the year and the fear that we're coming to the end of the cycle. So we know it's not earnings that have driven the sharp recovery. When we look at what has been the driver of that, it's really been the actions of central banks around the world, and in particular the US Federal Reserve, who really has done a complete 180-degree turn on its monetary policy settings. So we've moved from an environment where we're thinking, or the Fed was signalling that rates were going to go up 3 or 4 times over the next couple of years, to now a flat outlook and potentially a cut. So the talk about the Federal Reserve's interest rate policy in coming months is about cutting interest rates as opposed to raising interest rates. So why this is so important for investment markets and why it's been a driver of higher returns is the long-run interest rate that we use as professional managers in valuing future cash flows in companies is a really input to our discount rate that we use to discount back those future cash flows. So if we lower that interest rate, it means that valuations actually go higher. So we've seen that bounce back driven completely by a lowering in the expectation for long-term interest rates, driving valuations higher, and that's driven markets to pretty much all-time highs.
Tony, you mentioned earnings as a key driver of investment returns. Given that the economic data has been deteriorating over the past year or so, what does that mean in terms of the outlook going forward?
We're really focused on where we are in the cycle at the moment, David, and we really mean the economic cycle, because that creates the opportunities for assets and companies to post profit growth. And we did see that weaken into the back half of last year. Now, we think we're quite mature in this cycle. It's been extended for some period of time, and what that means is typically it's harder to maintain that growth. And that growth of economies, as it flows through to corporates, will actually impact the price that we're prepared to pay for assets. So where we see earnings at the moment is that there's probably a little bit of risk creeping into the market. If we look back 2 years ago, global trade volumes were in the 4 to 5% region. In the back half of last year, we saw that slow really markedly to 1 to 2%. So quite a tail off. During that period of quite buoyant global trade volumes, corporate profitability in the US, for example, was strongly double-digit. Now, some of that was tax cut driven, but we sort of think that it was 11 or 12% on an underlying basis. Now, the expectations going forward are for 8 or 9% growth over the next couple of years, despite the fact that we've had a bit of a pullback in the overall macroeconomic data. So it probably creates a little bit of near-term risk. Now, we're longer term than that, and we think about these things over longer term, 3, 5+ year time horizons. Excluding some sort of shock, we think the outlook's still reasonable and still okay. But with the material bounce back that we've seen in valuations now, we think the risk is back on any negative news on the earnings front could see a bit of volatility come into markets. Again, given our longer term investment horizon and lens, that could create an opportunity for us.
So in reference to client portfolios, where do you think the opportunities are and how are you positioning those portfolios?
Well, as you know, David, we look at things over the longer term So, 3 to 5 to 7 years plus across the portfolio. So it's important to reference where we see the opportunities over appropriate timeframes. We are seeing opportunities across a range of asset classes at the moment off the back of the lower interest rate environment, the lower for longer interest rate environment. It will benefit multiple areas of the portfolio. Equities is one of those areas where we think that there will be a major beneficiary of lower rates. As I mentioned, the discount rates have moved lower. We're actually seeing some good opportunities in the unlisted private markets parts of the portfolio, albeit very selective and very valuation driven. We're also expanding that view to interest rate sensitive type ideas across other listed and unlisted parts of the market, including we're having a good look at infrastructure at the moment as an example. We continue to think that the alternatives managers, again, there's some very, very different investments in what is a big allocation in the portfolio across things like long short equity, global macro, trend, and currencies offer varying degrees of opportunity, but we're really happy with the manager skill that's been coming through in the portfolios more recently there. So we're quite prospective in that part of the portfolio.
And this is an area that you've been building over some time, the liquid alternatives part of the portfolio?
Yeah, absolutely. And we've sort of reshaped that in the last 18 months, around some of those, again, it's very specific to our mandate around what we're trying to do, improve providing consistency of returns and in the event that we need to, protecting from downside in the event that markets go into negative territory. In throwing that open, I would also say that the Australian dollar and our view on currencies is another potential source of future returns that we're quite excited by, albeit that's, there's been a bit of a move lower to around 70 cents. We think it goes lower from here on interest rate differentials, and as things like the iron ore price rolls over, it's been impacted by a one-off impact of a tailings dam disaster in Brazil, and it's kept that price up. But as that sort of comes back, we expect the currency will be another generator of favourable returns for the portfolio. Where we're probably finding it harder to find opportunities at the moment are in things like some of the commodities, as I mentioned, iron ore, which is overpriced, but also really in bonds and in credit markets. So at the beginning of the year, US 10-year treasuries were trading at about 2.8%. Their yield, they're now at 2%. So bond prices are inversely related to their yields, so they've been very, very strongly performing. We've seen Australian 10-year government bonds, the yields fall from 2.3% to around 1.3%. So again, a very, very big move. That's meant that the price of bonds has gone up a lot. We're less attracted to that at this stage of the cycle. So in terms of portfolio positioning and how we're capturing that, we've got about a third of the portfolio allocated to growth assets, so that's things like shares. We've got about a third allocated to cash preserving type assets, lower return, but will aid in managing volatility and provide a bit of opportunity when we see volatility come along. And then we've got a third in the diversifying space, which is predominantly private markets assets and alternatives, reflecting our view on this environment.
So Tony, given the diversification that you do have across your portfolios, what's this mean in terms of the returns that clients can expect in their portfolios?
Well, David, one thing I always like to point out to people is that we are a diversified fund with a very specific objective. Our objective is centred around risk and a focus on that primarily with a view to providing more consistent returns and preserving capital when markets go into negative market environments, or holding onto as much capital as we can. So what that means is we're very diversified in our allocation to asset classes. So we're not only an equity fund, we're not only a bond fund. So if those are the strongest performing markets and they're running hard, you can expect us to not deliver those same strength of returns. Conversely, if we go into an environment where there's a big fall in equities or in bond markets, we're not going to be anywhere near as bad as those markets. So our long-term performance track record has been built on this approach. Looking at the opportunities in markets at the moment, we're quite encouraged by the outlook. In terms of equity markets, fairly valued, they're not incredibly overvalued. What could move them higher is potentially a further move down in interest rates. When we look at bonds, we're not as attracted to that, but we've positioned the portfolio away from that. So we're reasonably comfortable with hitting our objectives over the next 3 to 5 years in this type of environment.
So wrapping up, Tony, what are the key messages that you'd like to share with our clients?
Well, I think, David, we've had a very, very strong period of performance in investment markets and returns have been okay. We don't think that's going to be necessarily repeated in coming years. So be mindful of that, of where we're sitting in this extended market cycle. The benefits of diversification at this point in the cycle we think will play out, and again, timeframes are really appropriate. Like, people shouldn't be worried if returns have been a bit lower in recent times. The time frame is much longer than that, and we will go through various market cycles, and that's what a diversified approach allows us to do, is to provide more confidence in the future for our investors. And the other thing is we will be very active in the portfolios. We were in December when markets fell. The problem was they didn't fall for long enough for us to really allocate a good amount of capital, but we're going to get other opportunities, and the portfolio is well positioned to take advantage of that.
So that brings this investment update to a close. We'd like to thank you for watching this video series, and we'd also like you to reach out if you do have questions. Please ask your advisor, and we'd be happy to answer any questions that you do have. We'll see you next time.